from the Bertov Report. Welcome or welcome back to The Lens with Craig Shapiro and Larry McDonald. Since 2010, we host an institutional live chat on Bloomberg with more than 660 investors from more than 23 countries. If you're interested in joining us, please email Tatiana at thebertovsreport.com. Thank you and enjoy the
All right. Welcome back to The Lens, everyone. Special thanks to Adrian Days in the house, our old friend. Adrian, I just wanted to bring you in this week because, the inflows of gold, hard assets versus financial assets. One of the main points we make in our book, How to Listen When Markets Speak, is there it is, How to Listen When Markets Speak. Thank you, Adrian. Adrian's featured in the gold chapter. In the book, we wrote it about 2 years ago. We pounded the table on gold and the gold miners. And what we're seeing is in February, there was 27 trillion in the NASDAQ 100. And now we have about 24 trillion in the NASDAQ 100. So about 3 trillion less valuation. And the gold equities and the gold equities especially, there's only about $400 billion in all the gold and silver equities, right? So it's a rounding error relative to what's happening in big tech. And so as we see this migration into European equities, migration into U.S. Hard asset focused equities like gold miners, Adrian, I wanted to ask you, you would think that with this kind of market action over the last couple of weeks, and with the GDX up something like 30% on the year, which is the gold miner ETF, you would think that there would be some retail flows into gold miners, relative to previous cycles. Where does that stand now?
Yeah, we're just not seeing it. I mean, there's been a little bit of a shift, but very, very, very small. I mean, today our fund got a withdrawal. We got a withdrawal yesterday, a redemption. I mean, net redemptions today, net redemptions yesterday. You look at the GDX, which is the largest gold miner ETF in North America, and it's the one that most retail people use, most brokers. If you have a RIA who uses Schwab or Fidelity, they're going to be putting money into the GLD. That's where they would buy their gold. We've only had 1 day of net inflows this year, Larry. 1 day of net inflows this year.
Wow.
Which I find just astonishing. That was 2 weeks ago. It was 6.4 million. Since then, we've had 70 million out in the last 5 days. So there just aren't. There's just not a lot of interest in the gold stocks right now among most investors.
We have a chart. That's GDX versus Europe, and what's amazing about this chart is the GDX share count's going down, and the money flowing into German equities is really incredible, right? Relative to gold.
Yeah. Well, of course, Germany's had a specific thing to prompt some inflows. But recently you can see it right at the end there after the election and the fiscal agreement they came up with. But I mean, the truth is that money is flowing out of this year, has been flowing out of the US and into Europe. And that's part of a sort of thesis that, we had going back 6 months. But when the S&P starts to roll over, money will flow. It'll flow to many other places that have lagged. It'll flow to value stocks, to small cap growth, to dividend stocks, to defensive stocks, to European stocks, to emerging markets. But it'll also flow, I think, to commodity stocks. And some of the commodities have been doing reasonably well lately, commodity stocks. But the gold stocks just, I mean, let's not overdo it. As you said, they're up whatever it is, 30% this year. They're up 55, 60% in the last 12 months. That's nothing to shake a stick at. But it's not from individuals and small and RIAs. It's only from, I think it's from large, sophisticated investors that see the trade, but it's not from individuals.
So let me bring in Craig Shapiro, because we run a Bloomberg chat with hedge funds, mutual funds, and pension funds. Craig runs our Discord room with family offices all around the world, and it's like a live lens on a buy side conversation. So, Craig, what's the conversation today? One of the clients just mentioned the street is still up at two, and we mentioned this 2 weeks ago. The street's still up there at 270 for S&P earnings, $270. We're at 5,600 now on the S&P, so we're at 20, close to 21 times there. Right, 21 times. But if the S&P earnings are actually $230, we're at 24 times. And if you throw an 18 multiple on, say, $230, you get 4,140, right? Craig, I mean, is that what are the institutional chats saying today? And what's going on
Yeah.
with these?
No, I think that's a good flag. I mean, what we've been seeing over the last couple weeks has been individual equities across a variety of sectors that have been pre-announcing negatively, right? We've seen it in the airline sector, we've seen it in the home building sector, transportation sector, retail sector. So it's been a wide swath of end markets and companies that are talking that are talking about the slowdown, talking about tariff uncertainty, talking about margin pressure from inflation. And so, from a bottoms-up perspective, the earnings outlook doesn't look as good right now. And from a top-down perspective, right, GDP estimates for 2025 are only starting to get revised lower. And so the top-down guys that make the calls at these big investment firms on the sell side have been slower to take their top-down estimates for 2025 down. But all the work that we're doing on the bottoms-up sector basis suggests they're slow again to
So they're up at $270, and we might be in reality down at $230 in terms of S&P earnings.
Yeah, I think if you start looking at building up some of these sectors that have been missing, and then if that rolls into the tech sector more broadly, or more consumer discretionary names. Lulu reported last night, pretty poor. So it seems like it's broadening out. And the street, the top down guys have just been slow. I think only Barclays has taken down their estimates, and so this is how the information gets disseminated through the street. We've been seeing it in our chat. It's likely the sell side is going to move a little bit more slowly, and then it gets into the narrative, and then within the next 3 weeks, you're going to see more of these sell side firms taking down their estimates for S&P earnings and for S&P targets for 2025.
And Craig, this week in the One Idea, so we created this new product because most of our clients are hedge institutional investors, and so what we do each week is we created the One Idea. Craig and I put it together every week, and it's a lower price point product, but we take one observation that we're getting from the professional investors globally. And I think one of the great quotes this week that we put in the One Idea, went out earlier this week, was that so about $1.5 trillion, $2 trillion left the Mag 7. It went to Europe. It went to value. Now it went to value. So if you look at growth versus value, big shift there into value out of growth. But guess what? The financials are a big chunk of value. So what happened was the financials got really pumped up. Bank of America, XLF. At one point this week, the XLF was only off, only off like almost 3% for the year. And so that kind of moved, whereas looking at short the financials, short, let's say long something like the FAZ, that where that money was forced into the financials because money had to go somewhere. When $2 trillion leaves Mag 7, it has to go somewhere. It goes into Europe, goes into gold miners, goes into value. Adrian, let's get into your charts. Jose, can you bring up Adrian's charts? Where do you want to start off, Adrian?
Well, this just, I'm really just trying to emphasize here that both gold and gold stocks over the last 12 months have well outperformed the S&P. And, as you can see here, they're up by almost, by 3 times over the last 12 months. And I don't think the ordinary investor really knows that or understands
Okay,
that.
let's go back. In a real hard asset bull market, like we talk about in our book, How to Listen When Markets Speak, it's a bestseller on Amazon. In that kind of market, can you see a Newmont or a Barrick be in the top 10 stocks in the S&P? Walk us down memory lane.
Oh, absolutely. I mean, it's happened before the gold stock valuations right now, jumping ahead of ourselves, are very, very low. on a historical basis. You look at the XAU on a price to cash flow, it's within its lowest decile it's ever been. If you look at an individual stock like Agnico, which has more than doubled in the last year, I mean, it's a fabulous company. And yet you look at their price to cash flow, their price to free cash flow, both in the lowest decile in their entire history. And of course, when typically, traditionally, when the gold price moves up, the multiples start expanding, not contracting. So yeah, I mean, I think we can easily see that again.
Well, let's whip through the charts. Next chart, Jose. Thank you, Adrian.
People just don't know. This is the GDX flows that we were talking about earlier. You can see that one single day there, tiny little blip in green. That's a single day when they had net inflows. It's just astonishing to me.
So let's get back. So one of the things we talk about in the book is the DCF model, discounted cash flow. And so in 2022, we had the inflation surprise. Money moved out of growth into value and into hard asset type companies because we had elevated inflation. Then we went into this rate hiking cycle, and there was a belief. Powell promised us we were going to get back to 2% inflation. But I think what's happening in the market today, and we talk about this in the book, there's a realization that because of tariffs, we're not getting back to 1-2% inflation. We're going to normalize up in this higher range, 3-4, maybe even 5%. And if that's the case, the traditional discounted cash flow model, Adrian, walk us through. That's when the risk-free rate, if it's higher, that means that money should flow into companies that actually own hard assets like gold miners. Is that how it's? How do you look at it?
No, that's right. And also companies like gold miners that see their margins expanding. I mean, for the last 4 quarters, every gold mining company quarterly analyst call you listen to, they seem to spend half their time talking about cost pressures, what they're doing to contain cost pressures. Aren't we doing a good job with containing cost? Nobody says that the gold price has gone up a multiple of what the costs have. And so you've seen the margins expanding like crazy over the last 12 months. I was just talking to a company yesterday. Their cash cost at their mines is $978 an ounce. That's their cash cost, not their all in.
So this is a gold mining company that you speak to all the top managers. Their cost to get out of the ground is what?
Is $978. And it had gone up, and they were complaining it had gone up. I said, don't talk about it going up. Talk about the margin expanding, for goodness sake. But the whole sector, it's the sector with the most rapid growth in cash flow over the last 12 months. And yet nobody's talking about it.
Well, you know what happened? COVID hit, oil went crazy, and there was like 3 or 4 quarters where these companies, gold mining companies, and a lot of companies in the hard asset space, materials, they had so much cost pressure because of oil, and they disappointed. It was one embarrassment after the next. And I think that the street just got so, kind of like embarrassed by this. It was very embarrassing for a lot of analysts. And don't you think that's kind of what's happened? Is where now a lot of those now margins are going to start to expand, and people are going to start to come back to the sector.
No, absolutely. That was 2011, 12. People do have long memories, but I think they're beginning to forget about that. To me, my sense is that most investors, most small institutions, most brokers and RIAs, they're not looking at gold stocks and deciding not to buy them. They're just simply not looking at them. If they're just not interested in gold stocks. That's my sense. But you're absolutely true. You're absolutely right. If we go back 10 years, we had companies making massive mistakes when the price of gold went up to 2,000 or 1,900, whatever it was. People overpaying for very marginal assets. And I've said this to you before, Larry, or we've talked about it before. Within 2 years after 2011, over 75% of the investments that the gold mining companies made was written off. Not written down, written off. They were poor, very, very poor acquisitions that they made, and they overpaid for them. And of course, the XAU, the GDX, as you know, they declined by 86% from the peak in 2011 down to the bottom in 2015. I mean, that's a huge number. And people remember that for several years. They don't want to go back into that. And then they finally start stepping back into the space. And what happens? They buy Franco-Nevada, safest gold mining gold exposure in the world, and Cobre Panama gets shut down.
Yeah.
And then they buy Barrick, and Mali gets taken away from them. And so I think the generalist just says, I've had enough of this space.
I see, yeah. And that's when you want to buy, because everybody's been washed out. A lot of the hot money tourists have been washed out. And those hot money tourists in 2011 it was just spectacular. It was the hottest thing you had to own, gold miners. And there was a lot of tourists. And what you're saying is the tourists have been washed out. And, and walk us through copper. So we've got data centers coming online, I think, and one of the points we make in How to Listen When Markets Speak, our new book, is that we're going to have a copper crisis, like an OPEC type 1970s crisis for copper, sometime in 26, 27, because the demand, when you rebuild Los Angeles and you rebuild the Ukraine, and then you have all these data centers, if you look at the copper names this year, they're outperforming the market by a lot. I mean, I think by 17% or so. Sure. What are you trying to say with this chart?
Yeah, well, this is a chart. A lot of people have seen it. It simply shows the primary demand, which is the yellow line, and how starting at the end of this decade, and then certainly into the next decade, we simply don't have enough copper. We don't have enough copper to meet the primary demand. If you go to the next, and people have seen this slide many times before.
Next slide.
Green are possible projects. And a lot of those possible projects will not come on. Some of them have been, they're held up for one reason or another. Now, this shows you the copper demand growth is from BHP, which tends to be conservative on this stuff.
So this is BHP's view on copper demand growth?
On copper demand growth. And you can see that most of the demand growth for the next 10 years is coming from economic growth, energy transition, and digital. But my point with this graph is that even if a lot of people are saying they don't think the energy transition will happen as rapidly as the optimists think. I agree. Maybe all the AI build outs won't happen as rapidly as they think. China's already overbuilt, right? Their AI farms, energy farms, whatever you call them. Even if you cut those in half, just from normal traditional demand for copper, we still don't have enough copper.
Right.
That's the point I'm trying to make in this graph. And so, energy transition is a big boost for copper. But even if you cut it in half, we still don't have enough copper. And then the next slide shows, I think the next one.
Next one, please.
I'm sorry, there was no more slides.
No,
that was the last one.
Okay. So
well, bring my slides in then.
Yeah, but I think the point is clear. But with conservative assumptions on growth and reasonably aggressive assumptions on demand, on supply, we do not have enough supply. And I'll finish with this, Larry. The beautiful thing about the copper market, unlike, say, the gold market, is it takes time for big copper projects are big, unlike gold. You can have a gold project producing 40, 50, 60,000 ounces a year, cost you $100 million to build it. Copper projects are billions of dollars to build. And notwithstanding what the current administration is doing with cutting the timeline on permitting, which is wonderful, that's only for the US. It doesn't affect the rest of the world. And notwithstanding that, copper projects being so big, if you've got to raise $4 billion for a copper project, it takes time to develop that project, to construct that project, and to build it. So the point about the the point about that, the point I'm making is that you can look ahead 5 years and you can see the copper production with a very high degree of certainty. There's not going to be a major source of copper in 5 years, but we don't know about today.
And so the street now has taken down a lot of copper names in terms of downgrades. So the FCXs of the world, Tech Resources, a lot of these stocks have really cheapened up. And one of the things we wrote about recently is that there's like a cognitive dissonance where the last 20 years, 30 years, whenever you had an economic slowdown, the first thing people do is sell copper miners because they're just conditioned to sell copper miners when there's an economic slowdown. But this time, because of the setup, it's supply demand, it's much different. Adrian, thanks very much. So we do trade alerts on WhatsApp, in the Bloomberg chat, and Discord. You got us into the gold miners last year. We did 3 or 4 private calls with the clients. You can see the trade alerts there in September. We recently took down 1/3. We're still long 2/3 GDX, but we've just sold 1/3 because that's what you should have done the last couple of years. The bull case has been out there, but the sector, if you don't sell the strength, you typically regret it. So we're still long 2/3 GDX. If you want to get on our trade alerts, it's Tatiana at thebeartrapsreport.com. So let's next slide, Jose. And thank you, Adrian, for the guidance here on the trade alerts have been really helpful. Next slide. Okay, one of the things that the clients are talking about in the chat this week is the silver SLV versus, say, gold, the gold silver index. Silver's starting to outperform a touch. I mean, the gold silver ratio is still up at 89, but in a normal commodity bull market, that gold silver ratio should have a 6 handle on it. Adrian, here, as you can see, GDX, the SLV versus for big tech. You can see, isn't that an amazing chart? We're nowhere near. I mean, as money, once again, there's 24 trillion in the NASDAQ 100. If just a fraction of that capital comes out and moves over to hard assets, you can see the upside.
No,
Right.
Absolutely. Yeah. And it's not just silver, of course. I mean, you look at the whole, there's a graph going around a lot of people will have seen of the commodity complex versus financial assets over the last 100 years. And it's picked up a little bit from the bottom, but we're basically at a 100-year low in commodities versus financial assets.
Yeah, and once again, that's the strong dollar, that's rate hikes, and that's the street telling us that we're going to get back to 1-2% inflation. So everybody's conditioned to that 1-2%. And as we saw today, Craig, news today, you had inflation, a little surprise on the upside with PCE.
Yeah, two data points on the inflation front today. Core PCE, which is the Fed's preferred measure. I mean, Powell had referenced this at the press conference a couple of weeks ago, but came in at 2.8% year over year, a reacceleration, and the core month-on-month gain was up at 0.365, so rounded to 0.4%. So clearly, a rate that is too high for the Fed to be thinking about accommodating and easing. And then the second reading, which is, and the Fed's been talking about this, we've been talking about this a lot, is these inflation expectations. We've been seeing, because of the tariffs, all the prices paid surveys and the regional PMIs and the broad PMIs are showing that businesses are expecting higher prices and that they're looking to push through higher prices. And in the consumer and surveys of inflation expectations, also consumers are expecting much higher prices. So the Michigan survey, it's not the greatest survey in the world. It's highly political. It's only 600 people that are surveyed, but it's been around, quite some time. And a positive revision, over 4% expected long-term inflation, 5 to 10 year inflation expectation. So it seems like consumer, and that people will say, well, that's mostly Democrats. It's not Republican. It doesn't matter, right? Basically, what across society, folks are expecting higher prices because of the tariffs. We had the 25% tariffs on autos earlier this week. So this is in the public psyche. And the reason that's important is because it makes it much more difficult for the Fed to provide accommodation, loosening, rate cuts in when the economy starts to slow, if inflation expectations are becoming unanchored. And so I think that's the environment that we're seeing here. You see on the chart you have there, the commodity indices typically lead. And so the stuff you guys have been talking about on copper and on silver are breaking out. Hasn't happened on oil yet, but if oil were to catch a bid, we'd see more of that goods and commodity related inflation that will help drive up PCE inflation further. So look, I think the Fed is in a real tough spot here, unable to really provide accommodation in a stagflationary world where uncertainty because of the tariff regime and some of the other policies are leading to consumers and businesses pulling back. And, that seems like a very precarious setup for the economy and for risk assets at large.
Yeah, everybody's still long the 2010 to 2020 portfolio. Adrian, if clients or people want to position capital with your funds, how do they find you?
Oh, thank you. It's AdrianDayAssetManagement.com. Adrian Day Asset Management.
And you clear through, you're part of a larger group of funds? I mean,
well, we have the separately managed accounts, which is Adrian Day Asset Management. And we don't custody ourselves. Obviously, that's a dangerous thing to do. So we custody with RBC. And then we also run a Euro Pacific Gold Fund, which is
that's right, Euro Pacific. Yeah. And so you have the gold fund. Do you have a hard assets fund, or is it mainly just like gold? Or
it's just a gold fund. Yeah.
Okay.
So we have about 20% in silver, and the rest is 80% is gold. That's in the gold fund. In the separately managed accounts, we invest in copper and everything else.
So what do you think here? So one of our points is when the bull market matures from like the first inning to the second inning, the tourists, the hot money will start to look at the tertiary parts of metals. In other words, you'll start to see as the bull market matures, you should start to see capital start moving to silver and silver miners, right? And so when you're running your portfolio, are you starting to position a little bit more of the portfolio towards silver versus miners?
A little bit more towards silver, a little bit more towards the juniors. The junior stocks, obviously, they tend to, they catch a bid at the second, third, fourth innings, as you call it. I think that's an American term, isn't it? Something to do with baseball.
Yes.
But I said that the GDX had only 1 day of net inflows this year. You look at a GDXJ, which is GDX Juniors, you have to go back to August before you see a single day of net inflows into the GDXJ, which is just mind-boggling. But as the market develops, people start to look at, what's cheap, what hasn't moved.
But this is so unbelievable. I mean, gold is destroying the NASDAQ for 3 years, and there's no inflows into the GDXJ. I mean, it's just mind-boggling.
Well, did you hear them talk about it on CNBC? Has it been a headline in the Financial Times? I mean, people just aren't talking about it.
I mean, you can see here, we made a new low today in the Qs versus gold. The 2022 low is lower, but we're getting down near that 2022 low because gold's moved up so much. Next slide. But yeah, so Adrian, as that 24 trillion comes out of the NASDAQ 100, that capital is going to start moving toward your copper names, your gold miners, and so I think you're going to have a nice year of inflows this year.
Only a small amount will flow to gold, but as you mentioned, with let's say it's 600 billion in all of global gold stocks, you don't need much of that flow to go into gold stocks.
I think it's important to think about gold as from a market cap perspective, right? Gold has recently just crossed over the $20 trillion asset mark. I think it's up to 21 or so trillion dollars. You think about, global sovereign, the US Treasury market is over 36 trillion, right? Global sovereign debt is close to 100 trillion, and global assets at large, including stocks, real estate, everything, corporates, is close to $900 trillion of assets. So at 21 trillion on 900 trillion, we're talking about 2.5% of global assets are in, a store of value asset in this kind of changing world that's being, it's highly geopolitical, supply chains are changing, tariff regimes, retaliatory trade, geopolitical, issues, wars, it just, so from that perspective, gold seems highly undervalued versus where it traded historically as a percentage
Right.
of assets, right?
Adrian, yeah. So walk us through walk us through historically what percentage of say wealth managers or family offices had money in these
you see
hard assets.
different numbers for that. I mean, typically in the US it's 2%. It's been 2%. Right now it's about 0.5%, and most of that is very concentrated. I mean, it's a small number of people who have 10 or 15%, and the mass 80% have zero. But traditionally in the US, it's been about 2%. Globally, it's been about 4%. But of course, typically, as you know, if you go back to the 70s and earlier, Europeans always said you should have 10% of your assets in physical gold. So, I mean, we're way, way, way away from those sort of historic averages.
Right, exactly. And yeah, so the point that we make in the book is, we're at the beginning stages of this kind of evolution toward a hard asset portfolio, global value. And that's whether it be, just think of NVIDIA. NVIDIA now, ExxonMobil and Chevron are still only 29% of NVIDIA's valuation. ExxonMobil and Chevron are 29% of NVIDIA's valuation. And so as this whole CoreWeave IPO, Craig, this CoreWeave, let's finish it up with this CoreWeave. I mean, it just smells to high heaven. This is like Cisco in 2000, where is it true that NVIDIA was the anchor, and then NVIDIA in the same week is buying one of their own resellers? I mean, this stuff is like literally 2000 Cisco type language.
Yeah, and I mean, Jim Chanos has been talking about this, and obviously he's legendary for his short selling capabilities and how he kind of traded through 1999 and 2000 and Enron and like. And so, I mean, this talk about resellers and inventory management and accounts receivable management. And the CoreWeave IPO today, I don't know if it started trading yet, but clearly the deal was not as well received as people originally thought it would be. They had to downsize the deal. They took the price down, and it does look like NVIDIA has taken a quarter billion dollars of the 1.5 billion raised in order to secure the deal. With all the stuff about DeepSeek and the Chinese competition and the overbuild of CapEx.
Oh, there's the headline. Without NVIDIA, the deal would not have closed.
It's just, these are the types of things, and our friend Ben Bray talked about this earlier in the week, just about these signature deals that happen at peaks in momentum and peaks in understanding of narratives, right? We saw this back in the Time Warner AOL merger in 1999, the Blackstone IPO in 2007, the Glencore IPO kind of busted the commodity cycle in 2011. And this is another one of those kind of IPOs that's, very well followed and was seen to be to be a great deal. And now all of a sudden, it's kind of coming at a precarious time for the narrative about AI and the build out. And so ultimately time will tell, but it does seem like there's, some clear cracks in the armor here for the story about the AI build out. And I think the market is coming to grips with that reality. And we're seeing those flows out of the NASDAQ, which you've talked about. And these, there's a narrative now for Europe. There's a narrative for China about domestic spending on consumption, on defense, on infrastructure. A lot of that narrative didn't exist, prior to Trump coming in there again. So it's giving folks a reason to take their money out of the U.S. and bring it back home. And I think that's a dynamic we're going to continue to see here for the next, couple quarters for sure.
Well, Adrian Day, Craig Shapiro, thank you so much. The team back in New York, really appreciate it. Let's try to work on the slides a little better next time, but we had a lot of fun. Great to see you guys. Have a wonderful weekend, and looking forward to Easter coming up. And we'll be up in New York for the entire month of almost the whole month of April. But all right, guys. See you next week.
Thanks, Larry.
Thank you so much. Thank you.
If you're interested in any of the services mentioned all throughout this video, please reach out to Tatiana@thebirdshopsupport.com. Thank you for watching, and I'll see you next week. Bye.